All right, let's jump right in. We are going to unpack one of the most famous and, let's be honest, one of the most intimidating formulas in all of finance, the Black-Scholes model. At its core, it's all about solving one huge problem. How do you put a price on something that doesn't have a solid value yet? How do you price the future?
And really, that's what it all boils down to, isn't it? How much is a maybe worth? If I give you the chance to make a profit down the road, what is that opportunity worth to you right here, right now? And this isn't some philosophical riddle. It's a very real mathematical problem that traders have to solve every single day.
So to make this feel less like a textbook, let's use a real-world example. Let's say you want to buy a call option on IBM stock. The stock is currently trading at $155, and the option's strike price, the price you can buy it at, is also $155. You've got a year to use it. The big question is, what's a fair price to pay for that right?
Okay, so let's start with the simplest possible way to look at this. We're going to ignore all the chaos of the coming year and just fast forward to the very last day, the moment the option expires. What is it worth then?
On that final day, it's pretty simple. It really comes down to two outcomes. If IBM is trading below $155, your option is worthless. I mean, why would you use your special right to buy the stock for $155 when you could just buy it on the open market for less? You wouldn't. So payoff is zero. But if the stock is above $155, say at $170, then bingo, you get to buy it for $155 and make an instant profit. So this simple calculation gives us what's called the option's intrinsic value. It's the value based only on that final payoff. It's our first building block, our starting point. But it is definitely not the whole story, not by a long shot.
And that leads to a huge, glaring problem. Think about it. Right now, with the stock at $155, the intrinsic value is zero. So who in their right mind would sell you this option for nothing? The seller takes on all the risk that the stock could shoot to the moon, and you're paying them zero for that privilege? No way. A market just can't work like that.
Okay, so obviously we need to get more realistic. We can't just look at today's price, we have to think about what the price could be, and that, my friends, takes us into the world of probability.
Now, we can't see the future, but we can make some pretty smart, educated guesses. And the most logical place to start is to look at the past. How has IBM stock typically behaved? What are its usual ups and downs? We can use that historical data to start mapping out the possibilities.
So when you look at the data, you start to see a pattern. It's way more likely for IBM to move up or down about 10% than it is for it to have some wild 25% swing. See what we're doing here? We're taking that fuzzy feeling of uncertainty and turning it into actual numbers, actual probabilities.
And once we have those probabilities, we can do something really, really cool. We can multiply each potential outcome by the chance of it actually happening, and then we add all of that up. This gives us what's called an expected value, a single number that represents the most likely weighted average return.
And when you run all those numbers for our IBM option, you get this, 9.75%. Now, this is a much more helpful number. It's not just a zero. It tells us that, based on history, our average expected return on this option is 9.75%. Okay, now we're getting somewhere. We're getting much closer to a fair price.
But wait, there's still something missing, a really big piece of the puzzle. This number is all about the final price at the end of the year. But what about the journey? What about the risk of the stock going on a wild roller coaster ride for the next 365 days?
And that brings us to the final and maybe the most critical ingredient in pricing an option. You have to put a price on risk itself. You have to account for volatility.
Yeah, the source material explains this perfectly. The price you pay for an option is often called the premium. And that's exactly what it is. It's a premium the seller charges for taking on all your risk.
Just put yourself in the seller's shoes again. They are on the hook for a full year. The stock could go anywhere. They need to be paid for sticking their neck out, for riding out all that uncertainty. That payment, that fee, is the option premium.
And this chart shows it perfectly. That sharp blue line, that's the simple intrinsic value we talked about first. It's the payoff on the very last day. But that smooth pink curve, that's the actual price of the option in the market on any day before it expires. And you see how it's always higher? That gap between the pink and blue lines, that is the risk premium. That's the value of time, hope, and possibility.
So here's the ultimate challenge, right? We need to find a single price that perfectly blends together intrinsic value, all those probabilities,
and a fair price for risk. How in the world do you combine all of that into one single equation?
Well, back in 1973, two guys named Fisher Black and Myron Scholes figured it out. They published a paper with the answer, and their work didn't just earn them a Nobel Prize, it completely revolutionized the world of finance.
And here she is, the famous Black-Scholes formula. I know, it looks terrifying. It looks like it should be on a blackboard in a physics lecture. But I promise you, the idea behind it is actually incredibly simple and, well, beautiful. Let's break it down. Forget all the weird symbols for a second. At its heart, the formula is just a subtraction problem. That's it. It figures out the value of what you might get, and from that, it subtracts the cost of what you have to pay. The price of the option is just the expected benefit minus the expected cost.
So let's look at that first half. You've got S, the stock price, times that ND1 thing. You can just think of ND1 as a very clever probability factor. So this whole first part is basically the value of the stock itself adjusted by the probability that you'll end up owning it. It's what you stand to get.
And now the second half. This is what you have to pay. X is the strike price. That gets multiplied by another probability factor, because you only pay it if the option is worth exercising. And super importantly, it's discounted, because you're paying this money in the future, not today. It accounts for the time value of money. But you know, the truly game-changing idea here was that the formula completely removes personal feelings about risk from the equation. It doesn't care if you're a daredevil or scared of your own shadow. It works by creating a perfect, risk-free portfolio in theory. And that totally shifted the focus of finance from just guessing about risk to precisely calculating the price of a risk-free opportunity. Now look, is the model perfect? Absolutely not. It makes some big assumptions, like that volatility never changes, that we know aren't true in the real world. And yet, this imperfect model basically gave birth to the modern derivatives market, a market worth trillions of dollars, which kind of leaves you with a really interesting question to chew on. If a model gets the world just right enough, can it still change everything?